All right. Hi, everybody. Thanks for joining us today. My name is Tobias. I'll be your host together with Lisa, my colleague, and we've got quite an exciting topic to cover, if I may say so myself. But before we dive in, a bit of background first. So for decades, venture capital and private equity was the playground of ultra wealthy insiders and institutional investors. Now, thanks to new European regulation, this type of investment opportunity is available to private individuals as well. And this provides a massive investment opportunity for, well, you to invest alongside experts who've been doing it for years. Today, we'll dive deeper into what this means and how carbon equity is the first in the Netherlands to unlock this type of investment and this type of opportunity at unprecedented low ticket amounts. So together with Lisa, our Chief Climate and Impact Officer, we'll try to unpack the opportunity behind our latest exciting fund, why we believe it's a game changer for anyone who wants to invest in the net zero economy. So we're aiming for a, let's say, 30-minute conversation. And at the end, as Lisa just mentioned, we'll have time for questions. So please do feel free to shoot in the Q&A box and we'll try to address them later on. So Lisa, for people that are new to carbon equity, besides being one of the co-founders, what's your role at the company and what do you do on a, let's say, daily basis?
Yeah, well, thank you, Tobias. It's so exciting to be here. I'm so excited to be having this webinar together with you. We only spent 4 years getting this product live, so really unique moments. So my role, I'm Chief Strategy, Chief Impact. On the strategy side, I lead the development of new products. And so designing this ELTIF fund, getting it ready, that was one of my big projects last year. And on the impact side, people call me the conscience of carbon equity. Per investment product, I decide what our impact objectives are. I design our impact due diligence processes, and I sit on the IC, our investment committees, where we actually decide to invest. We're with 4, we're unanimous, which means I have a veto vote. So I personally feel responsible for all of the impact all of our products have.
Nice. So let's say you're essentially at the intersection of where strategy and impact comes together at carbon equity, right? So not just deciding or shaping what we build, but also why. And like you say, and I typically refer to it as well, you're the gatekeeper to make sure we stay on the right path, right? But all of that comes together in this new fund, the Access to Climate Tech Fund 2. Can you tell a bit more to the people that joined today on what motivated you to get this live?
Yeah, absolutely. So let's see, we started thinking about carbon equity 5 years ago. We went live 4 years ago. And the founding thought was really, we want to create a product where people like myself can put our capital to work for the energy transition. The thinking behind it is actually, I spent my thesis for my research master on this. It's very hard to have real impact in public markets because all of the companies in public markets are mature, meaning they can go to the bank to lend money if they want to grow. They don't need to give new shares out for that. And so what it means is that if you invest in a green company on the stock market, you buy shares from someone else and the company doesn't directly benefit. At the same time, there's many, many amazing companies bringing the next generation of climate technologies to market. But these companies are still too small to be on the stock market. So these are startups and scale-ups. And those are funded on what we call as alternative investments on the private market. So we think helping those companies grow is the most impactful thing you can do. But for there, you need to be in alternatives. Before we started carbon equity, you really didn't have many great options to invest in these climate startups and scale-ups. Maybe on a crowdfunding website, you can find something, but you invest in one and some startups go bankrupt, so it's very, very risky. Or maybe if you have a great network through, you can invest in your neighbor's company as an angel investor. But a really professional, well-diversified, managed opportunity to invest in climate startups didn't exist. And so that's what we set out to do.
And can you perhaps give just a few examples of what carbon equity has achieved thus far?
Yeah, so let's see. 4 years ago, we started. Today, we have 300 million euros under management from almost 1,300 investors. We've launched 10 funds. We funded more than 200 companies. We've committed to 27 climate funds. I'll get back to that, exactly how this works. But basically, we've become the most active climate fund investor in the world. We've funded more cool technologies than I knew existed, and there's plenty more room to grow.
Nice. And we'll get to a few examples later on. But just when you look at it from a few example technologies with incredible founders that you came across, if you were just to give a few quick sort of to give people what a bit of an expectation there, what would be something that stands out?
Let's talk about three. So Vervo Energy, one of my favorites. They make geothermal energy possible almost anywhere. So the earth is really hot, but getting the heat out of the ground is not always easy because we need water to flow through. And so certain rocks are permeable, so a very technical term, it means water flows through easily. Most rocks are impermeable, doesn't flow through. Vervo has taken the latest technology from fracking, which we usually use for oil and gas, and are applying it to the earth to get the heat out effectively. And it's a company where I just think they're really, really smart about what they do. They're bringing the oil and gas people to renewable energy at scale. And the company's only 5 years old, but they're already building a facility of 500 megawatts. And to put that in context, that's 400,000 households that they're powering. And they already started to slowly float the idea of an IPO and actually making an exit to the stock market next year. Another one is Metafuels, and there's actually really exciting news last week. So Metafuels makes sustainable aviation fuel. Their technology is dual pathways, so they can use bio inputs, so waste biomass. They can also use hydrogen and CO2, so fully synthetic. It's a Swiss company. Their technology is much more efficient, so they maintain much more of the energy that was already in to turn that into the fuel, making it cheaper. And they just announced they're going to build their first factory in the port of Rotterdam. So the Swiss are coming to us. And a third company I really like is Syre. They do textile to textile recycling. So typically, if you're done with your textiles and you put it in a bin somewhere, it will be used to, I don't know, fill up cushions in cars, but it's not really put to good value. And Syre will make sure that the t-shirt becomes another t-shirt. And they already have a 600 million offtake agreement from H&M, and are also already building their first factory, even though this company is only 2 years old.
Yeah, so I think these examples they're quite young, right? But they demonstrate a massive growth and big opportunities behind it. All right, so these are a few examples on a portfolio company level. You also mentioned we've invested in 27 fund managers. If you were to name just one that you're really proud of,
so let's take one quick step back. We invest in fund managers, right? So that's not like obvious for everyone. Why would you do that? Carbon Equity builds fund of funds, as it's called. So it means that we select other funds, venture capital and growth equity funds, infrastructure funds, and they invest in startups, scale-ups, and projects. The reason we do that is that we get to work with the best experts anywhere in the world. So we're talking earlier stage, later stage, different kind of technological focuses. And that way we can make sure that the money is really well diversified. So you really manage the risk profile of the fund. And we have the smartest people working in every niche. So talking about specific fund managers, let's definitely touch upon some European examples thereafter. But the one I'm probably most proud of is that we invested in Breakthrough Energy Ventures, which is the fund that was initiated by Bill Gates 20 years ago. And it took us 2 years of networking and being very professional to get us in. We're the first Dutch investor, and we're the first fund of funds to invest with this platform. They're a bit exclusive.
I was going to say, I can imagine you can't just pick up the phone and give Bill a call, right?
No, we couldn't give Big Bill a call. So it was around just every type of opportunity we got, making friends. And actually, in the end, we got lucky that one of them also came to us. There's a team in Brussels, and somehow they came to one of our events and we got talking. And that's how the ball ultimately started rolling.
Nice. And I guess that's what we mean when we say invest like a pro.
Yes, yes. I mean, investing like a pro, in the end, it means investing in something that just has a really good risk, return, and impact combination of facets. And we really think that if you want to go in alternatives, your best way is to go with these professional funds because they really know what they're doing.
No, fair enough. Now, taking a step back as well and look at the audience, right? You mentioned that people that are dialing in, probably they've, invested in public equities, maybe some trackers or ETFs, uh, private bankers, perhaps crowdfunding even. Let's pretend I'm a person interested to invest through carbon equity, and I've got, just a few options to put my capital to use. Say I already have a mix. What would you, recommend me adding such a fund to my portfolio? What would be the main reasons?
Let me see. I think we already touched upon most of them, but let's unpack them a little bit, right? So the first is impacts. I really think that if you want to help accelerate the energy transition with your capital, investing in startups and scale-ups is the best option that you have. So that's one. At least for me, it's a very important one. Second is diversification. So there's a lot of publications around investing in alternatives, and it's democratizing private equity is a big theme. But basically, private markets have a bit of a different dynamic from public markets. So spreading your capital on both is a smart thing to do to manage the risk profile of your portfolio. Third is the target return. So because private markets are alternative and there's a few things that are different about them, for example, it's less liquid. We'll get to that in a bit. You would want a little bit of a higher return target compared to public. And the same goes for our fund. So the target return is 8 to 12%, which is higher than the average of 7 to 8%, which you get on the public market. And I feel like I'm missing one, but maybe you can help me there.
I would say access to the top experts as well. That's
Yeah.
something that you just can't get into yourself. I mean, mention Bill Gates and his fund.
Yeah. And if I can add just access to these companies, at least for me, like in the end, I just get so excited about like investing in these companies, helping these companies succeed. I also think this is the biggest opportunity of our generation. I think many of these companies are going to be hugely successful. So I'm just really excited to have this exposure.
Nice. So then if we look at this fund specifically, right? We've set up a few funds before. We've had some successes there. But this particular new fund, can you give people a sense of what they will be investing into, like strategy, mandate,
Yeah.
focus?
The fund is the first ELTIF fund of Europe or of the Netherlands, which means that it's more accessible than our previous funds. The minimum investment amount is 20,000 euros. And we will invest that in at least 5 fund managers. But we're planning to also do co-investments next to that. So let's unpack it a bit. The 5 funds, we plan to diversify really well, all of them within Europe, which makes this fund different also from our earlier funds. So we'll invest in early stage venture capital funds, meaning these are really startups that maybe have a great idea on technology, but they only just started selling it. We'll invest with growth managers, which are really investing in companies that are already making millions in revenues, but they want to scale that to the tens or hundreds of millions. And we'll also invest a little bit in infrastructure, which means we're not investing in companies, but in projects. This is mostly solar and wind, but it can also be battery storage or car charging or a biogas plant. So overall, that way, we really want to diversify again that risk profile within it. Just bear kind of like in terms of technologies and sectors. So to get to net zero, we need to transform 6 industries. We're talking about energy production, industry, food systems, buildings, carbon management. Which one did I miss? Did I mention industry? Anyway, we'll make sure that the capital is also spread really across these 6 sectors, meaning that with the portfolio, our investors will contribute to almost everything that we need for net zero, but also, again, really nice diversified across different sectors and markets.
Yeah, so let's say a well-diversified, balanced product that people can get into for low tickets.
Yeah.
I'm going to tie this to a question that I just saw on the chat as well on our oldest funds and whether they're on track, right, from a return perspective, because obviously we're investing, so we're aiming for a return next to impact. Why do you believe it will be interesting from a return perspective, this particular fund? And can you sort of tie that back into what we've seen in our older funds in terms of traction?
Yeah. Okay, let's break it down. So why do I think investing in climate technology is exciting? Well, the energy transition is unfolding really rapidly, in part because governments and companies and people care, but also because this technology just tends to be better. So most climate technology is just more efficient than fossil fuel. And that means that once it gets to scale, it's cheaper. And we've seen that with more and more technologies now. So solar energy has become the cheapest source of energy ever in the history of the world, and that will probably never change again. And because of that, last year in 2024, 80% of all the new electricity installations we did worldwide was solar. Like, this is a statistic I can get over. 80% of all the new electricity generation we built in the whole world last year was solar. And we're seeing same just rapid development and really kind of exciting maturity of battery technologies, heat pumps, electric motors, and this technology is taking over the world. And I think China is really showing that, being a market leader. It is still like almost hard to understand that it's such a political hot topic because the fundamentals are just so clear. So anyway, sorry, tying it back down. So why is this exciting? First of all, this technology will win from a cost perspective. Solar is already there, batteries are already there, and that will be kind of the breeding ground for many other technologies to follow, kind of the fundamentals other technologies can build on. Secondly, energy independence and energy security has become a massive topic. Renewables is much more local. Europe, for example, is dependent on other geographies for fossil fuels. We don't like that. The European Union is, for all of those reasons, really doubling down on climate tech and will continue to do so in the next couple of years. We're also looking for kind of like actually not only doing it for energy independence, but these are also a lot of the growth sectors of the future. So chemicals, novel batteries, these are the kind of technologies Europe also wants to build as an export product. And so we'll really double down and focus on to make sure that these sectors will grow.
Yeah, and how do we see that back in previous or older carbon equity funds in terms of performance? Do we see that sort of hypothesis we had back then a few years back coming into play now?
Yeah. So as we say in private equity, our funds are shaping up nicely. So private equity, you need a bit of patience, right? So the lifetime of our funds are 12 years. And generally, it's hard to say something really kind of material about performance in the first 5 years. But still, we do. So what we've done is we've done an analysis of the companies we've invested in over the years, or the companies our fund managers have invested in, and how those are performing. The oldest vintage in our portfolio is 2021. It's the first set of companies were funded. Those today, the investments we made are 40% increased in value since then. So for every euro we invested in 2021, that's worth €1.40 today. The companies that are in there increased even more in value. But because we do follow-on investments, the value of the investment doesn't increase as much as the company. So a lot of value increase and also reflected in our portfolio. For 2022, we're talking about 27% increase. For 2023, 17% increase. Now, all of this is really in line with what you would want to hit your target return. So we're on track, but it is still early.
Okay, fair enough. And I guess people open up newspapers as we do, and they read headlines, and these are all very promising results, right? Or at least signals of future performance. But what if you think of geopolitics? What do you think of, the US view on climate policy, Trump, subsidies, global trade tariffs, trade wars, or the potential thereof? Wouldn't you say these pose massive risks for climate investing in general?
Yeah, so it's not good news. I think everything that's happening in the US is just not good for almost no one in the world. I think probably the worst thing that's happening is creating uncertainty. And so it's very hard to make long-term investments in a world where tomorrow everything can be different. At the same time, the fundamental drivers are still what they are. So when we're talking about clean technology being cheaper than fossil fuels, that's just a fundamental driver. It's not going to change. The value of energy independence and building kind of the industries of the future
Mhm.
that is remaining similar. And so for those reasons, we still see in the US many investments continuing. Also because despite the uncertainty, there are certain sectors. Well, first of all, just the US still needs more electricity demand for data centers, for industry, and most of that is being filled with renewable energy, geothermal, nuclear, solar. There's still a lot of companies that are just building technology that is so exciting that despite Trump, it's continuing. We're also continuing to invest in the US, even in an electric trucking company a few weeks ago. But it is a little bit harder in the US right now because of uncertainty. I'm really happy to see Europe saying, we're not going to do what the US is doing, we're going to step up. And for us, decarbonization, climate technology, those are going to be our growth industries of the future. And I feel that every signal recently from the European Union has been in line with that. I'm actually going to Brussels tomorrow to discuss the newest startup and scale-up strategy that the European Union is going to publish tomorrow. And there, it's very clear, we're going to double down, we're going to help startups and scale-ups in climate tech. This is our future. So a lot to bank on there. And all of this is in the context of a transition that is already rapidly accelerating.
Yeah, so I mean, personally, when we're speaking to investors as well, we hear a lot about, narrative changes, also
Yes.
within government, right? Where politicians are moving away from using words like climate policy, but rephrasing it to energy or rare mineral independence,
Yeah.
which ultimately, comes down to something that we focus on as well. And especially since this fund will focus mostly on Europe, do you think there really is a place for Europe to step up and become a leader in this domain?
Yes. I spent a lot of time thinking about this. My answer is yes, but we do need to get our act together. When it comes to patents, Europe is on par, even outperforms even US today in clean technology. We have a few really strong industries already within clean energy. One of them is wind, for example, wind power. And there's amazing startups and scale-ups on the ground here, many of those who we've helped fund. A few things really need to improve. One is making it easier for companies to grow also across borders. But there, for example, we see that the European Union is really planning to harmonize things more. So it's going to be easier to grow in Europe. And the second is we need the public funding that we have to go to the really kind of transformative and innovative technologies rather than the things we already know. And that's what we're currently talking about together. But no, I think the opportunities are there. The question is where, right? I think maybe it's not smart to still try to compete with China on solar panels because they really figured out how to make them. But when it comes to, for example, new types of batteries or green chemistry or novel proteins, these are really opportunities I think Europe can still seize.
Cool. Then looking back these past few weeks or months, essentially since the start of Trump, I guess, there is a lot of turbulence on financial markets.
Yes.
How should a private individual whose probably portfolio is pretty well focused on listed equities, how should they look at this, given the especially the US foreign trade policy, right? But how global stock markets have been quite hectic and there's still a lot of uncertainty. How does this affect carbon equity strategy and outlook?
Yeah. So going back to earlier points, private markets have a different dynamic compared to public markets. And so the thing with private markets, it's very long term. It also makes that market is a bit more, let's say, focused on fundamental drivers and long-term forecasts rather than short-term, which dominates public. So what's actually much more important is what will the market 8 years or 10 years from now look like when these companies that we're investing in today need to make an exit? Because in 8 or 10 years, they might want to go to the stock market or do another kind of exit. But precisely what's happening on the stock market today doesn't directly affect the private companies you'd be investing in today. And so it's actually a nice part next to your public portfolio to have something that's a little bit more stable and a little bit more long term. There are indirect effects. And so what we do see is that when public markets go down, valuations in private markets tend to also decrease a bit. Oddly, that makes it a good time to invest. So as private equity professionals say, buy low, sell high. that really is the case.
So it's an opportunity, you would say, right now.
It is, but like you need a strong stomach, right? Like you need a strong stomach to, in a world that feels volatile, to commit your capital for 12 years. Like I really get it. And so it requires you to take a step back and think like, okay, what future do I think the world is really going to? What is the fundamental potential I think clean technology has? And if those things are something you're comfortable on and you feel like there's some of your capital that you can lock up for 10 to 12 years, then yes, I do think this is a very exciting time to invest.
All right. And if I may get a bit personal, we talked about the opportunity. We talk about, whether it makes sense from a portfolio perspective overall. When I speak to investors as well, many of them think that skin in the game is important, right? Alignment of interest and all that. So do you personally also put your money where your mouth is?
I do. First time I'm sharing this publicly, but I've invested about 25% of my investable wealth in carbon equity funds. And it's actually been a very interesting process to go through the same kind of decision making as our customers do. Because also for me, committing my money for 10 years was a big decision. And I don't know where the world's going to be in 10 years. I don't know where I'm going to be in 10 years. And so kind of figuring out in the end for me was much more around first just getting comfortable with that very different way of thinking about investing, right? You need to think long term. And then secondly, figuring out what share of my wealth I was comfortable really committing for that longer term. I ended up at about 25%, a little bit in all of our funds. I'm really excited to be doing so. I'm really excited about like being actually like vested in all of these companies, tracking them, seeing their growth. And vast majority of people working in carbon equity are invested. It's also something that I'm really proud of.
Nice. And would you say it was a scary decision to make for you personally? Because obviously you have access to information that others don't, right? You're doing this on a daily basis.
It wasn't scary about the actual investment. So for a few reasons, I'm super bullish on climate technology. I just am really excited to be invested in this category. So even if the worst case scenario comes to pass and I don't get my target return, I'm still going to be proud of my decision and happy that I contributed. And thirdly, I think what's good to understand about this fund is diversification. Like, what does it actually mean? If you invest in one startup, you can lose all your money. A startup can go bankrupt, you can lose everything. It's happened to me with crowdfunding and angel investments. If you invest in a fund of funds, you have exposure to more than 100 companies. That risk doesn't exist. It's not binary. And so I think with this strategy, we're committing to 5 managers. Statistically, there's a chance of about 5% that the money I receive back in the end is going to be less than what I put in originally. So I actually don't consider this to be an extremely risky investment. So the biggest thing for me to get used to was the illiquidity, the fact that I am investing for a very long time. And that took me some serious kind of like getting comfortable and figuring out how much. It might be a good moment to mention there are a few like small windows to get out of this fund early if you really must. But there's no guarantees because there might be more demands than possibilities. So it's not something that we're advocating loudly, but we have created like little emergency exits.
Yeah, so people can sort of, indicate whether they want to sell part of their investment at a certain point, which
Yes.
might happen, it might not, it depends.
Yeah, well, it will happen, but maybe not fully. You can get out a little bit. We don't recommend it because financially it's not a smart thing to do. But just because we understand you can't predict every scenario in life, we wanted to create some possibilities.
Yeah. No, but I guess it's a good consideration for people to make because this is the main difference between private market and public, right?
I think so, yeah.
And it's hard to.
One other difference that's good to mention, a little bit technical, but the J curve. So what is also different for private markets compared to public markets is the target return is 8 to 12%, but it doesn't mean that every year if you log into the app, the value of the portfolio will have gone up 8 to 12% because in private equity, it first goes down and then it goes up. for many kind of technical reasons, but mostly because it takes a while for startups to actually increase in value. But that's just also something that I think you really mentally need to prepare yourself for, that even if the fund's on track, you're not going to see that target return in the first couple of years.
Yeah, it's all about when distributions actually take place.
Exactly.
All right. If we're, we just talked on your personal investment experience with carbon equity, but let's talk about your sort of personal meets professional hat as well. You see hundreds of different companies, different sectors, different stages, different technologies, different markets. If there is one that really stuck out to you personally, which are you truly excited about?
That is a good question. I already mentioned three that I'm really excited about. Okay, I'm going to mention one, maybe a little bit unconventional, but we just invested in my brain. I'm terrible with names, but in the US, a company that makes electric trucks. I just talked about them.
Harbinger, yeah.
Harbinger, thank you. To me, so I didn't talk about my background, but before starting carbon equity, I was an energy transition expert at McKinsey. I knew a lot about kind of like how quickly we thought the energy transition was going to unfold, how quickly technology was going to improve. Everything goes so much faster than what the experts believed. And Harbinger is a perfect example, because 7 years ago, we didn't know whether it's going to be possible to make electric trucks. We didn't know if batteries were going to, or regardless of cost, are what going to get dense enough that we could like get them on a truck and still like have capacity to put goods in that truck. Now batteries are so good that you can invest, you can make electric trucks in the US and they can compete on cost alone. So Harbinger is making electric trucks that are cheaper than diesel trucks in the US, despite Trump, despite everything, purely because technology is so amazing.
Yeah, that's awesome. And they take care of a lot of, let's say, transport emissions, right? So from an impact perspective, that's massive as well.
It's massive. Yeah, it's amazing. Yeah, just because of electrification of road transportation, so cars and trucks, we're going to hit peak oil probably this year. Probably worldwide, the demand for oil is going to start to decline. That's just because electric vehicles are so good.
Nice. If you were to ask me quickly,
yeah, what's your favorite company?
My favorite, it's not necessarily my favorite, but it's a good example of something that sort of combines my personal life, if you will, together with the work we do at Carbon Equity. But it's 1,5, which for the audience is, let's say, a full stop shop for making your home more sustainable from an energy perspective, right? So they help you with installation of heat pumps, batteries, solar panels, or a mix, depending on what's best for you. And they do this, it's a German company, but they do this within Europe, and they're active in the Netherlands as well. So long story short, I just bought a home and I'm looking to make it more energy friendly. So I got in touch with the company to see if they can help me make my home more sustainable. So this is something that I sort of came across through carbon equity, and I can now, besides working with indirectly, actually use it in my home environment. And what is cool is with their AI powered software, they can actually help you manage your electricity as well, even feeding it back into the grid when prices are good, and storing it in a battery, for example, when prices are not so great, to put it back into the grid. So you might actually make money on it as well, which I think is very cool.
Cool. I didn't know that. They do keep targeting me on YouTube, so that part I did know, but not that you are actually experiencing them from the other side. Fun fact about 1,5, it's a German-founded company, but the founder worked at Tesla before the long time. And we keep seeing this in the climate tech ecosystem, that a lot of people who worked at very successful climate tech companies kind of learned the ropes, how to scale fast, and then kind of go on to the next idea and the next technology, and build something new.
Yeah, that's very cool. Which I think says something about their motivation as well, right? As well as perspective for the opportunity behind it.
Yeah, it's amazing to talk to these climate tech founders. Like, I talk to them quite a bit because we have like these fun meetings, and also we invest directly. They come to our events, and it's really the most inspiring thing to actually be hearing from these people how motivated and excited and committed they are, and they just keep going even after 1 or 2 or 3 exits. There's like the next idea is already bubbling.
Oh, very cool. I'm just looking at the time, and we still have a few moments left for the Q&A side of things, and we do have a few that came in. So one is a bit technical on the return side of things, but the question is on, can we explain the difference in expectations for Climate Tech Portfolio Fund 4 and this Access to Climate Tech Fund 2 from an IRR, so a rate of return perspective? Because there's differences, right? Fund 4 targets it's between 12 and 15% on an annual basis, whereas Access to Climate Tech Fund 2 targets is 8 to 12. So how is that different? Why?
Yeah, very good question. So few components. The first component is that, as I said, there's emergency exits in this fund. To create those emergency exits, we only invest 90% of the capital that people give to us in private equity investments, and 10% will keep in listed money market funds to create that liquidity. So that is one kind of little step down compared to the portfolio funds. And the second is that we're going to add some infrastructure funds to the mix. And infrastructure funds have a slightly lower return profile, but are also much lower risk. And we just feel that for this group, for this fund, that is the smarter thing to do.
Okay, so part focus in terms of different funds, but also the liquidity buffer, which is positive if you want to use it as an emergency exit, right? And also that 10% you're likely not going to lose anyway.
Exactly.
Yeah, but it does eat up your return because you can't invest it. All right. Then another question. We talked about your skin in the game, Lisa. I can talk a little bit about mine. Spoiler alert, I also invested through carbon equity. But you mentioned some of the other employees as well. Do you know, if you look at sort of from a total perspective, carbon equity skin in the game, how would that look like? Like shareholders, carbon equity itself, the investment team. Can you tell a bit more on how that skin in the game sort of comes into play?
I'm not sure what you're looking for, but I think 75% of the people that work at Carbon Equity invest in our funds, including almost everybody in our investment team. So that's one. And people tend to invest also a material share of their wealth, not just something very niche. Most people that have invested in our company, we have a few investors in our company, are also investors in our fund.
So we're talking, let's say, key personnel, founders, investment team, shareholders.
Yes, absolutely.
Yeah. All right. Then somebody's asking about the fund selection side of things, in particular for this Access to Climate Tech Fund 2. I mean, we're a little bit stressed in time, and how would you summarize it in short?
Yeah, very short. We have two people who did this for a living for a decade at AlpInvest, the most established fund investor probably in the world. So they take care of return, risk, kind of general due diligence. On the impact side of things, I've designed our processes, iterated them a lot with everybody that would want to talk to me, including the big pension funds, and definitely developed a very sophisticated approach, if I may say so myself. There's a lot of this in the data room. We'll probably do a follow-up webinar, but this is really one of the things that we believe makes us unique.
All right. And then I've got a fun one, I think. It's about whether small capacity nuclear power plants of the future will have a bigger or smaller percentage than solar in the global market of electricity supply. What do you think?
I love it. 100% solar is going to win.
Yeah?
Yeah, I mean, solar is the cheapest source of energy ever. It's only going to get cheaper. It's already 80% of the world. It is so easy. Like in Pakistan, fun fact, like we didn't know, but suddenly 30% of all the electricity generated in Pakistan was solar. And we only found out once we started looking at satellite data. We had no idea because it was just individuals buying a solar panel from Alibaba, getting it to their home, plugging it in themselves. This is just, it's so easy, it's so rapid, it's so modular. That's never going to change. However, the sun doesn't always shine. So, and you don't always have the space to put the solar panels. So for those kind of instances, you might want to have other sources of sustainable electricity. And that's where small modular can really play a role. One exciting company in our portfolio, Elemental, just signed a 600 megawatts, so again, 500,000 homes, but then with Google for data centers. So we're starting to see this more small modular revolution in nuclear, and it's great, but it's never going to beat solar.
Ion solar, nice. Then we have another question on fee structure of the funds. Could you perhaps explain a little bit on how that's set up?
Yeah, so there's two levels of fees. The funds we commit to have fees, and then we have fees. The funds we commit to typically charge the typical industry average, which is 2 plus 20, 2% management fees per year, 20% bonus if they outperform compared to or perform kind of in line with what they've promised they would. We charge about 1%, I think 1.1%, but it goes down if you bring your friends along per year, and a one-time setup fee, but no performance bonus. We think that is not the right thing to do. We want to make sure that there's still a very attractive return for our investors at the end of this. There is some fund costs, but we are really kind of structured ourselves very well to keep those very low. There was one more part I thought was important to mention. Oh yeah, we do up to 20% of the fund in co-investments, something we haven't talked about before, but we invest directly in companies together with our fund managers, with the managers we know well. For those companies, we don't charge, or the fund managers don't charge fees. So there you only pay our fees and not the underlying 2 plus 20.
Yeah, so that reduces the overall.
That reduces the overall cost load quite a bit.
Yeah.
And can I just plug, we're 2 times cheaper than any other competitor we know for this ticket size. So we really, really worked hard to make sure this is the most attractive investment opportunity for people that want to go alternative.
Yeah. And that ties into another question that just came in on projected internal rate of returns is indeed after deduction of costs and fees. So those are net, right? Those are to our investors. Yeah. And fun fact on the co-investments, I just want to tap into there for the final minutes, more or less, that we have, which also ties into a question from Patrick, who's very active on the question side. So thank you, Patrick.
Hi, Patrick.
So he's saying, like, you talk enthusiastic about certain companies. Thank you but our business relations is only direct through the fund managers. But that's not entirely the case, is it, with these co-investments?
No, so through co-investments, we have a direct relationship, but also these companies really like what we do, like to be connected. So we've had probably at least a dozen founders on our events by now. We do regular interviews, like we're pretty closely connected. There's a lot of founders that we also help kind of if they want to raise follow-on capital. We open our books, what kind of funds do we know, what introductions can we make for them? We're really quite friendly. And so if you invest with us, I can promise you, you'll get to meet a few of them.
Which I think is a nice way to end. And Patrick waved back, he's just saying. No, thanks everybody for joining. If there are any questions that we're not able to cover, please do let us know. We'll follow up with you through email, or we can have another call with you directly as well if you want. Thanks for joining. Thanks for your time. And why Leonardo DiCaprio introduces himself as Tobias Grinwis, I do not know, Zora, but thanks for the comments.
That's a good ending to it all. Thank you so much for dialing in, and see you at the next one.
Ciao, bye-bye.